in the financial field. As you all know, we have done webinars on multiple topics of financial planning, asset allocation, mutual fund, a specialized investment fund, NRI taxation, and so many other things. All those details are always available on NISM website. Recordings of past webinars and some key points discussed in those webinars, as well as details about upcoming webinar, and you can register through that. NISM again is, as very well known, is a SEBI's education capacity building initiative with the objective to make general people aware about various aspects related to capital markets, not only general public but even the professionals involved in the financial market, and which is where in the series of activities that we do, we bring you these investor education webinar. Today's topic is most popular discussions these days amongst anywhere we go in our friend circle, family circle, professional circles, our offices, corporates, with our advisors, is gold and silver. The obvious reason being the kind of return that both these commodities, or other precious metals, I should call them, though they are part of the broader commodity space. So the kind of return that they have given, it has obviously come into the eyes and attention of all of us. So that's where we thought that this is a topic that we will bring to you. How much gold and silver is enough in your portfolio? And at the same time, who better to speak about to speak on this topic and to speak about various details related to this topic than Mr. Vishal Dhawan. Vishal is a certified financial planner and co-founder of Plan Ahead Wealth Advisors, leads a SEBI-registered investment advisory firm that supports residents and NRI families in achieving their life goals through meaningful financial planning. Plan Ahead has won Outlook Money's Best Investment Advisor Award for 2016 to 2019 and secured second runner-up at the Plan Plus Global Awards Asia region in 2017 and 18. Vishal is an economics graduate and an MBA in finance. He has worked with marquee names like ICICI Bank and ABN AMRO before co-founding Plan Ahead, which he co-founded in the year 2003. With around 3 decades of industry experience with him, he writes regularly, hosts radio shows, and appears on multiple businesses and general media platform. And that's why I said, who better than him to enlighten all of us on this topic of gold and silver. Vishal was a founder director of ARIA, received the Ken Gillespie Legacy Fund Scholarship from Money Quotient, and has served in key roles at the Financial Planning Association USA in cross-border financial planning. He is passionate about life planning and enjoys reading, traveling, and exploring global newspapers. Over to you, Vishal. Before that, one last thing. So for all of us as listeners, as attendees, as viewers to this webinar, post this webinar, hopefully we should be able to answer some questions to ourselves, that how much gold and silver should be there in the portfolio in terms of weightage, in terms of asset allocation to these asset classes. And that is the key objective that is there for today's. This will be an interactive session, but of course, in the initial part, Vishal will give his presentation, and after that, we will open it for Q&A session, in which you can type in your questions in the chat box, and Vishal will be taking those questions. Over to you, Vishal.
Thank you so much, Kunj, for that lovely introduction. So I think one of the interesting things when I was working on this presentation was that I did not need to focus on the returns that gold and silver have generated in the last 1 year. There were two challenges that I faced. One was that everyone seems to know it. And second is that number changes so dynamically every day that depending on which day I'm making the presentation, that number will be wrong. So one of the things that you will notice is that there is no specific mention of returns that have got generated in the more recent past on gold and silver. I think it's also partly coming from the fact that part of our financial advisor in us has us worried that whenever there are asset classes that deliver supernormal returns, it is not uncommon for them to be followed by periods where returns can be very poor. And one of the important things that we'll try to spend some time on today is helping webinar attendees understand from history what really happens with returns over a period of time, and how should they be viewing gold allocations in their portfolio. So I'm just going to start with my presentation. I'm assuming that my screen is now visible to y'all.
Yes.
So, so over this next 45 minutes or so, and then we'll obviously have questions and answers as well, which you can take up. We will try to spend a little bit of time around what may be a good strategic asset allocation to think about when you look at gold and silver. We'll talk about the challenges and valuation around what is the right price of an asset like gold and silver. And we'll also talk about how to manage risk as an Indian investor who's participating in gold and silver in multiple forms. Um, I think one of the very, very critical things to keep in mind is that fundamentally there are three big reasons why people have had gold and silver in their portfolios, more specifically gold, because that tends to be the bigger allocation that most families tend to have. So, one part of it is, of course, cultural in the way that we are. So, fundamentally, if you go back in time and look at how gold has been used as an instrument, you will find that it's what we would define as a cultural anchor, which means that it's a, without thinking too hard, assets for generations have got transferred from one generation to another, either at the time of wedding, either at the time of birth, either at the time of death. Essentially, it just got transferred very, very easily from one generation to another. And therefore, by default, it has been an asset that has always been held long term in portfolios. And because it has been held long term in portfolios, the volatility that has happened along the way of gold has tended to be forgotten because investors, even as we speak to them right now, will virtually always tell us that I will only use gold or sell gold to support my financial goals in case of an absolute emergency. And therefore, that's one of the very unique characteristics of gold, probably even more than real estate, in terms of how people, especially in our country and many parts of Asia, have a very natural inclination to be long term investors, which works very well for assets. The second, important part of gold has traditionally been its ability to be used as an inflation hedge. And one of the trends that has become very popular, especially in the last year or so, is how precious metals hedge against what is called currency debasement. And I'll spend a few minutes around currency debasement. So, again, if you study history a little bit, you would realize that at various points in the past, starting from the Roman Empire to when there were British kings in the 1500s to more recent times as well. Every time there is a concern that there is no real value for the coins or the rupees or the dollars that you hold, there is this fear that, you know, let me move to assets which have real value. And traditionally, a lot of people have believed that precious metals, because of their relatively short supply, become those natural hedges. And therefore, they become real purchasing power protection. So typically, you'll find that when inflation becomes very high, which happens when currencies debase, people move to assets like precious metals, and therefore the benefit of inflation protection normally comes in. And data over long periods of time does show that it protects against inflation. I think we need to segregate the protection against inflation from the beating inflation capability. So what you may find over long periods of time is that it may not beat inflation significantly, but it can protect against inflation. Unlike, say, a bank deposit, which typically will give you returns which are lower than inflation, over long periods of time, gold and silver type of precious metals can actually give you returns which are a little above inflation, though normally not as much as other assets which can beat inflation quite meaningfully. The third very important thing is that the hedge against a currency depreciation like the rupee has traditionally seen against the US dollar. is something that gold has hedged and provided help against. And the reason why I decided not to share any returns data, like I was mentioning at the start of this webinar, is because we are in a unique situation where you also have the Indian rupee falling very rapidly over the last few months. And therefore, when you look at gold prices in INR terms, you are seeing the combination of what is happening to gold prices on the upside and what you're seeing happening to the rupee as it continues to fall. And the same story is playing out with silver as well. So typically, what you will end up finding is that there are three big reasons why gold does find a place in portfolios. And what we would call, um, alpha, which has become a very popular word, typically, which is, driven around um, something giving you higher return than something else, which is a benchmark. Traditionally, gold has tended to become now a non-cyclical alpha pool simply because the rupee tends to depreciate reasonably consistently over long periods of time. So if you go back and look at data historically, you will see this being fairly secular. At some point, hopefully, it will change. But for the last many, many years and decades, this has been fairly consistent in terms of a rupee depreciation. And that's where gold also has a role to play in terms of what it protects you against. Now, let's move to one very important thing, which is that, there is a question that often comes to us saying that the advantage of buying gold is gold never goes down in prices. And therefore, it's a very good asset to actually hold. And people worry about the prices of other assets going down. So they worry about, the stock market going down, which is now represented by the Nifty 50 here. They worry about the US markets going down, but somehow they believe that gold prices never actually go down. So one of the things that we did is mapped for the last 10 years, what is the correlation between the assets, which are, for example, the Indian stock market and gold, silver, and the S&P 500 representing US stock markets. A negative correlation essentially means that prices go down when the prices of the other asset go up. So, for example, gold and the Nifty 50 have a negative correlation, which means that when the stock markets in India go up, often gold will go down, and vice versa, when the stock market goes down, gold will go up. So, the advantage of this is that when you put it together in a portfolio, you have two assets which are behaving differently from each other. In fact, they are negatively correlated, which means when one goes up, the other goes down, and vice versa. So, it's a bit like a seesaw where it actually helps you to get the benefit of diversification truly. And also at times where stock markets don't do well, when people are concerned, typically when stock markets don't do well, you do end up finding that the economy also is not doing very well. Jobs are at risk, businesses slow down. So a lot of those things happening at the same time could coincide with gold prices actually going up. And therefore, it does end up being a very good hedge during market downturns, both equity markets as well as economy downturns. Silver, in contrast, does have a small positive correlation with the Indian stock markets. Um, so you will find that very often the stock market in India and silver prices will go up together, though the correlation is very small. It's only zero point 0.1. And therefore, to that extent, that is not big enough to worry enormously about it. But as we go forward and see how silver actually is used versus how gold is used, it will become pretty obvious that silver's correlation with equities will probably end up being positive in most timeframes and not negative. Between silver and gold, the correlation that typically has been demonstrated over the last 10 years has been about 0.69 or closer to zero point 0.7, which means that they go up and down together quite often. And I think, therefore, for a lot of investors who may be buying gold and silver today, saying that, I'm diversifying my precious metal exposure, That may not truly be the case because both of them are likely to go up and go down together. In fact, you will notice that at times the correlation between gold and silver goes up to about zero. 0.9, which means that they're very, very closely correlated to how each of them perform. And if you look at it against the US stock markets, you will typically find that the Indian stock markets and the US stock markets are correlated to the extent of about zero. 0.4 over the last 10 years. Over longer periods of time or over shorter periods of time, this correlation can vary as well. It ranges often between zero. 0.4 and zero. 0.6 to zero. 0.7. So again, if you look at it from a hedge perspective, gold is probably the only asset here which is negatively correlated to the Nifty 50. And therefore, to that extent, it gives you true benefits of diversification when you start to construct portfolios. The one piece of place where I've used returns is a very interesting reality that in the last 20 years, gold has actually outperformed equity in rupee terms. Um, so gold returns over the last 20 years are about 15% a year. Indian equity returns are about 14% a year. And real estate, represented by the Residex data that is published by the NHB, used by RBI, has given about a 7.7% return. So I think one of the important elements here for investors to keep in mind is that very often you can pick one piece of data and assume that this is actually a reflection of what will happen over every 2-year period. And this is probably the risk that all of us will be exposed to, because when we look at presentations, when you look at media, you will probably see headlines coming up somewhere saying that gold outperforms equity and real estate over the last 20 years. And therefore, we will, in our mind, imagine that over the next 20 years also, the same thing will happen. Or over every 20-year period, the same reality will play out. If you look at historical data, you will typically find that when you look at multiple rolling periods, these returns of 15% delivered on gold are abnormally higher than the normal rolling returns that you see over this period of time. And therefore, one of the things that investors need to be very cautious about is not to be taken in by the fact that because the last 20 years on gold have been as good as they are, it now becomes the dominant asset class in my portfolio. Um, One of the very, very sharp data points that I want to bring back into focus is going back to a point that I raised right at the beginning of this meeting, saying that, gold prices never fall. And this is very interesting data. If you go back in time and look at data, you have this dark blue section and then you have a gray section. Okay, now the dark blue section is actually the fall in dollar terms from the previous peak to this peak. So if you look at this data here, you will typically find that from top to bottom, the fall was roughly about 57.5%. Okay? Similarly, from this top to bottom, you had a very sharp fall that took place, right? So I'm just going to give you some data for you to get a sense on this, because there is a lot of disbelief that happens, especially when gold does very well, for people to forget that there have been periods where gold has actually fallen in value as well. And when it has fallen very sharply. So in 1980, gold prices were about $835. Okay, this is 1980. In 1999, okay, this is 20 years later, gold prices were $255. They went from 835 to 255 over a 20-year period. Remember, we just saw another 20-year period just now where the returns were 15% per annum. In dollar terms, you saw a 70% decline, which happened during this period of time. Now, what the gray line shows you is the gray line is the return in rupee terms. So what happened is, because the rupee also depreciated at the same time against the dollar, if you bought gold in India in INR, your returns, the negative returns were much lower. So instead of making a minus 57 or a minus 70, you made a minus 25 or you made a minus 35. But you still lost a lot of money in spite of being a long term investor. And I think one of the very, very critical things that we need to keep in mind is that these periods of drawdowns are also quite often. These are not rare. These periods happen quite a lot. And therefore, when you are making investment decisions on gold, do factor in that drawdowns are a feature of this asset class as much as they are a feature of other asset classes like equity, for example. And that is exactly what I showed earlier, which is the negative correlation between equity and gold, which is that when equity goes up, gold could be coming down at exactly the same time. So keep in mind that even a 20-year holding period in gold can sometimes still mean that you don't make money. In fact, just for academic interest, the $835 that you saw in gold in January of 1980, that 800 odd dollars, same price, only got achieved in the end of 2007, which meant that journey of someone who bought in 1980 and stayed invested and did nothing with that gold, he came back to the same level only in 2007. And you and me know that it's very hard to stay invested in an asset class for 25, 27 years when it makes you no returns or negative returns. And therefore, somewhere along the way, someone who was an investor in gold would probably have given up, saying that these kind of time horizons and timeframes are very difficult for me to actually deal with because the time frame is too long for me to manage. Now let's come to silver a little bit. So the way we what define silver is that we think silver is what I would call leveraged gold with amplified returns both on the upside and the downside. So typically you will find that, like I mentioned earlier, the correlation of gold and silver ranges between zero point 0.7 to 0.92, which basically means that both of these go up and they go down together. But the volatility of gold versus silver is such that silver is about 2 to 3 times more volatile as compared to what um, gold is. And the beta is about 1.5 to 2.5 times. So fundamentally, what you have to be ready with on your silver journey is very sharp ups and downs. And you will find that when you look at peak volatility numbers around silver specifically, you'll find that there are periods along the way where you could have seen volatility of about 40 to 50%, which have happened around how prices have moved. And very often that silver price movement will happen in very short periods of time. And because the price movement will happen in very, very short periods of time, it will be very uncomfortable for investors. And I want to use an example of you driving up a hill or driving downhill. Now, what you will find is that very often when you're, let's say, going to a hill station on a holiday or driving on a terrain which is hilly, if the curves are far apart, your ability for your stomach to handle that ride is much easier than where you have constant turns in and out, which are happening as far as your uh, road is concerned. And it makes you very uncomfortable. You feel like throwing up. You need to take stops along the way. You may need to take medication to deal with those situations, etc. I think a lot of times that silver investors need to imagine themselves going on a sharp ride, which they will take along hilly mountainous terrains and be ready to deal with those sharp turns, the volatility that will come along the way, and the discomfort that it will provide, because that's the nature of silver. Now, let's just spend some time around how silver gets used. I think we spent some time around how gold gets used for various purposes. The interesting part is gold has very little industrial consumption and industrial demand. In the case of silver, very often you will find that the industrial consumption of silver is roughly about 50 to 60% of the total demand. And there is a linkage to how well the global manufacturing cycle is doing and how trends around things like electronics, renewable energy, etc., are taking place. And like I mentioned earlier, the correlation to equities is positive, which means that it also goes up and down a little bit like equities go, because equities are also driven by global manufacturing cycles, trends around how the economy is doing, etc. So 50 to 60% of demand for silver comes from this segment, and 25 to 30% demand comes from investments. And what I mean by investments is similar fears that people have around gold cause investment demand for silver also to go up. It could be inflation, it could be monetary policy, it could be currency devaluation. A lot of the drivers of what happens with gold on the investment side are also with silver. Um, but typically, what will end up happening is that because of the fact that both of these things drive silver demand, it will be subject to how the industrial and economic cycle is doing, which is by nature cyclical. And it will also be driven by how the hedging part of your economy needs to work, which is counter-cyclical or the opposite side. So with silver, the reality is that this difference of 10 to 20%, because if you add up these numbers, they will not add up to 100%. That's because depending on whether you are in a cyclical growth environment or a counter-cyclical monetary hedging environment, you will see this demand share actually on the investment side pick up or on the industrial side pick up as well. So a lot of what will happen with silver is both of these. And that's why silver is a slightly more complicated asset as well, because what it requires you to do is keep your eye open on both parts of the cycle as compared to just gold, which is focused on only one element as far as the cycle is concerned. Okay. Now, I'm sorry for a very, very busy chart, but I needed to drive home some points around silver, just so that some of the popular narratives around silver can either be backed by data or actually rebuffed, because there are lots of narratives going around silver as an asset class. And this is quite common. Whenever any asset class does very well or very badly, you will find that the narrative around that asset class will come up. So one of the realities around the narrative, and I'll just start with supply, this goes back to the last 10 years, is you will find that production of silver or the supply of silver through mining production has largely remained constant. It hasn't really gone up. So one fact remains that you're hardly seeing any fresh supply of silver coming into the market through mines. And there have actually been some mines that have got into situations where there has been a problem for being able to extract more silver from there. We know that silver is actually a byproduct as well of other production processes around commodities, and therefore there has been very little fresh supply on the mining side. On recycling as well, you will see that for the last maybe about 5 years or so, the amount of supply getting recycled has remained roughly constant. So on the supply side, you will notice that supply has remained fairly consistent and very flat for the last many years. Um, so one of the realities around silver is supply flatness and very low volatility. Now we'll come to the demand side. And the reason why supply and demand is important is because in any asset uh, and any commodity, demand supply is a good indicator of what happens in the future very often. Though it's not perfectly correlated, and I'll explain to you also through this data how it is not perfectly correlated. So if you look at demand for industrial uses of silver, you will notice that it has moved from about 491 here to about 677. Okay, so the demand has gone up fairly steadily and much faster than what the supply has been. And when you actually go into looking at different elements of where that supply increase has come in, you will find that a lot of it has come from electronics, um, and you will notice that jewelry, for example, has not been a driver of silver demand till a particular point, but that has also come back quite strongly in the last few years. And therefore, when you look at the data, you will typically find that the demand increase has been much sharper than the supply increase. And therefore, one part of the reason why silver prices have gone up is because there is a demand supply mismatch that is taking place in the marketplace. And we saw this play out very, very extensively in the run up to Diwali, where you found that there was no supply. And therefore, the prices of silver went about 15 to 20% higher than what the actual price of silver was. And that was a complete supply demand mismatch that took place during that phase. Now, in addition to that, there is also investment demand, like we spoke about. Now, investment demand can come either through people buying physical silver, so that could be through jewelry, buying silverware, etc. Or it could be coming through what are called exchange traded products, where you will notice that the demand for exchange traded products of silver have actually gone up in the last couple of years. And therefore, when you look at what has happened to supply demand on a net basis, one of the big reasons for supply and demand um, causing prices to go up has been this mismatch. So, a lot of the narrative today is saying that because silver and demand, supply and demand is mismatched, please expect that silver prices will continue to go up rapidly as a result of that. Now, what I just want to spend a little bit of time on is for you to understand that this demand supply mismatch is not a new unique phenomena. It started to show up in 2019 at a very small level. And then it's remained in a deficit mode for many years now. But in spite of that, if you notice how prices of silver moved, they did not move up as much. They did move up a little bit, but they didn't move up too much. But in the last 1 year, they've gone up dramatically. And the reason which is being said is there is a demand supply mismatch. So I think what we need to understand is for 5 years before that, even though there was a demand supply mismatch, prices did not go up. For the 1 year after that, the demand supply mismatch has caused prices to go up. And therefore, you have to ask yourself, saying that could some of this price increase that has happened been delivered, been achieved through a combination of FOMO, which is fear of missing out, and speculative activity, where speculators pile on to assets, where the recent prices show a very good and powerful rate of return because there is a recency bias that automatically comes in when you have strong returns from any particular asset class. One of the popular things that exists is a concept of what is called gold and silver ratio, which looks at the the ratio between gold and silver prices to arrive at which of them is overpriced or underpriced. So if you look at long-term data, you will find that this average is somewhere in the region of about 69. Okay. And currently this number is closer to about 74, 75. So one of the things that people assume when they look at this is that because this ratio is 74 and not 69, it means that silver prices are undervalued. They will only go up. One of the important things to keep in mind is that when you look at ratios, because ratios have a numerator and a denominator, not just one element of it, you could end up finding that this numerator normalizes by gold going down more than silver also. So there can be multiple ways in which normalization of a gold silver ratio can take place. And therefore, when you're in a bull market, there is a tendency to focus only on prices going up as the basis for normalization. The normalization could also come through a price correction, which is what I think is very important for investors to keep in mind as well when they make choices around how to look at these kind of ratios. So therefore, the big question is that how does one look at dividing money between gold and silver? Our belief is that anywhere between 70 to 80% of whatever allocations you want to make to precious metals could come through gold. The rationale behind it is that it is your long-term asset. It is your asset for wealth preservation. It has a negative correlation. It helps to hedge currency, and it also helps to stabilize the rest of your portfolio. So I would call it what what I would term as a safety core in a portfolio. Now, this is, of course, again, I'm repeating that this is the out of the 100 rupees that you will allocate to a combination of gold and silver, what is the breakup between them? This does not mean that you have to put all your out of your overall 100 rupees, you need to put 70 to 80% in gold and 20 to 30% in silver. In the case of silver, we would call it what I would say the growth satellite. So essentially, because you would remember that we termed it earlier on as a leveraged gold instrument, which means that it can go up more than gold at certain points in time. You could take a 20 to 30% exposure to silver within the 100 rupees that you allocate to gold and silver together. And the advantage is that besides giving you access to precious bull metal markets, it could also give you access to how the industrial demand cycle works out. So, a lot of the futuristic growth potential around electric vehicles, solar, etc., could potentially, cause silver prices to go up when those particular industries are doing very well. Again, we need to keep in mind is those industries also go through their own uh, oversupply and demand mismatch cycles. So, when you look at some of these industries as well, like solar, for example, you may have an oversupply position lying there. So, by default, just because industrial demand gets served through silver for solar, but if solar itself is oversupplied, then you need to be very careful about the fact that this industrial demand cycle could actually be working against silver rather than anything else. So, what you're trying to do through this combination is get the safety bucket and the growth bucket together in a manner where you have demand drivers for each of these being different from each other. What I think you need to do when you look at your overall portfolio, which means your overall 100 rupees, is start to ask yourself saying that, what am I as an investor and how am I as an investor? If I'm a conservative investor, which means that I don't like volatility in assets. I'm very uncomfortable if an asset went down for 20 years or 15 years or 10 years, like we saw in the case of gold as well, historically, or even silver. A lot of people will remember that, in 2011 or so, silver prices were at the same level as they were at some point in 2025. It's only been in the more recent past that silver prices have actually gone higher. And therefore, for conservative investors, the role of gold and silver is really coming there to stabilize your capital and become a fundamental hedge. And typically, we would say that these sort of investors may be well off by having 5% of the allocation to gold and silver combined. Clearly, we still continue to believe that within gold and silver, there is a mix of assets that you can look at. But 5% of your overall money could potentially go there. If you're a moderate investor, which means that you're okay with some level of volatility on one side, you want diversification to be sort of balanced, and you want to also hedge against inflation, then that number moves from 5% to 5 to 10%. And if you are an aggressive investor, which means that your rest of your portfolio will also be very aggressive, and therefore you need buffers against the other elements of your portfolio. And you also want risk around systemic problems, which means that something fundamentally goes wrong and I want to protect my assets, then maybe that number will go up from 10 to 15%. But we certainly are not do not come from a school of thought that because the recent returns on gold and silver have been very good, we should be having 50% of our money exposed to gold or 40% of our money exposed to silver. I think that's a good approach for traders to consider because a lot of traders might evaluate following a trend. In fact, if you go back in history and look at some of the data carefully, you might find that just because gold goes up for 1 year doesn't mean it goes down in the next year. It may go up in the next year as well. But it's important to think about it from an asset allocation perspective, saying that longer term, 5 to 15%, depending on the type of investor I am, is probably a good measure for what I need to do. And like I said, within that, a 70 to 80% in gold and a 20 to 30% in silver is probably a good split to work with. The important part here also is to rebalance. And what I mean by rebalance is that if your mix becomes excessive, because let's say prices of precious metals have gone up by, on an average, 75 to 100% over the last 1 year, as a result of which your 10% allocation to gold has become 15%, then I think it's important for you to sell 5% of your asset and bring it back to 10%, even though you may miss some more of the upside uh, that might occur. And the other one thing that I think is very, very important to keep in mind here is that when people look at gold and silver in their asset pool, they somehow differentiate between their physical silver and physical gold from their gold, which is in financial assets. And I think that's a very fundamental mistake to make because ultimately the price of the financial asset exposure to gold and silver will also be driven by the same drivers as the physical price is driven. And therefore, it's important to ensure that when you're rebalancing, you rebalance keeping both in mind, not only the financial assets. Now, I'll move to just a couple of more important things. One is if I want to buy gold and silver, what is the vehicles that I could use and what are the tax efficiencies or inefficiencies of being able to make decisions around it. So, sovereign gold bonds were a very popular instrument. They were very popular because they allowed you to buy them, hold them to maturity, gave you some interest along the way. The earnings that you got on maturity were tax exempt. But recently, all those issuances of sovereign gold bonds have stopped. And therefore, the primary exposure vehicle for most investors will end up being exchange traded funds or ETFs. And what will happen is that if you buy an ETF and a long term holding is defined as 12 months, if you sell after that, you will end up paying 12.5% as your tax on the gains that you have made. And there is no indexation benefit. And therefore, it's a good option if you want to look at exposures tactically or even longer term. In contrast, a gold fund of funds, which could be in turn investing in an ETF or buying gold companies, which are there internationally, would have a 24-month holding period very often. But the rate is still the same 12.5%, and there is no indexation. So typically, one of the things that you might want to think about is what is my investment vehicle choice if I want to buy gold and silver? One of the important advisories is that there is also a lot of digital gold. A lot of payment apps, a lot of jewelers offer you what is called fractional gold or referred to as digital gold. There's a lot of confusion around ETFs and digital gold being the same tool. The reality is they are not. Uh, uh, digital gold, digital gold is not classified as a security, and therefore it is not regulated by either SEBI nor RBI. And therefore, you have very limited or actually no legal recourse if something fails around your digital gold holding. And it may also not have audited gold in volts equivalent to that amount. In fact, there was a recent guidance from SEBI as well as a warning to investors saying that, avoid going to digital gold because it is not regulated by us. So if you are trying to build precious metal exposure within the framework that we described, you might want to stick to ETFs and funds over digital gold as an option. So I think just to summarize all of this, typically, look at the advantages of having gold and silver in your portfolio. There are essentially some elements. So one is, like I said, the biggest advantage is the structural Indian rupee depreciation hedge, which is very helpful. And global investors don't have access to that. This is also very helpful when you start to plan for goals which may be international, like uh, education for your children, travel, etc. Assuming that you have a long time frame for those goals as well, a part of your allocation could go towards these kind of instruments. The second reality around gold is that it's a very powerful diversifier. So it does protect your portfolio against shocks, which may happen either in domestic equity or in real estate. When you do look at gold, look at some small allocation to silver, which acts as a leverage growth engine, provided you have the risk tolerance to deal with that, especially when there is a supply demand mismatch that might emerge because there is a lot of demand coming on the industrial side. And lastly, it's very important to have a overall picture constantly in your head saying that my allocations will be anywhere between 5 to 15% because of the fact that I need to um, you know, manage the risk of what is there. I also need to be disciplined with how I buy, so I will use regulated instruments. And I also need to be rebalanced wherever possible so that it can work well, and be mindful of the taxes, because whatever is the return that I will make will be the net of tax return, not the gross return that a lot of investors talk about. So this is what I wanted to present, but happy to take questions and any other items that might come up.
So can we do that poll question and answer for the
Yeah,
part?
sure. Please do that.
Yeah. Yeah. First question is live, sir.
Okay, so question number one is what is the correlation between gold and Indian equities denominated by the Nifty 50? Please choose one of the four choices. Option A, highly positive. Option B, strongly inverse. Option C, very low positive. And option D, high negative. So has everyone had a chance to fill that in? And maybe I'll just wait for a second in case there is still anyone who hasn't done that. So will the answers come up at the end, or should I just give the answer right away, Sahil?
No, sir, it will be visible to them right now as well after ending the poll.
Okay.
Yeah.
Okay. So, um, so I
Just
should
stop.
not give the answer right now, right? I can just go to the second question, or should I give the answer?
No, sir, you can give the answer right now if you
Okay. So
want.
the correct answer is very low positive, which is approximately 0.07, right? Okay. Let's go to the next one. Um, so the question two, sorry, I think it's gone off my screen. It doesn't seem to be on my screen, Sahil. Yeah. Okay. So approximately what percentage of silver demand is industrial? Uh, Answer A is 10. Answer B is 30%. Answer C is 50 to 60%. Answer D is 90%. So the correct answer is 50 to 60%. We can move to question three. So question three is, what is the long-term capital gain tax rate for gold ETFs held more than 12 months? Option A, tax-free. Option B, slab rate. Option C, 20% with indexation. Option D, 12.5% flat. So the correct answer is 12.5% flat. And option D, question four is, what advantage does gold in INR have over gold in USD? Option A, higher volatility. Option B, zero negative decades. And C, no difference. So the correct answer is zero negative decades. So what essentially happens is because of the rupee depreciation, like I was mentioning, over a 10-year period in rupee terms, there has not been a period where you have had negative returns on gold, even though in dollar terms, there have been periods of that kind where returns have been negative. So those were the 4 poll questions for you. Thank you for taking that poll.
So there are few questions in Q&A section where
Yes. So maybe
attendees
I can
have
take them
asked.
if I could
Yeah,
take those. So there's
yes,
a
please.
question by Sushmita Kumari, which would be better in the long term, ETFs or mutual funds? Now, when you're a long-term investor, the fact that there is a 12.5% tax rate on ETFs, which is after 1 year versus 2 years in mutual funds, does not matter as much because I'm assuming that long-term is far beyond a 2-year holding horizon. Now, when you do that, you will find that the ETFs can be slightly cheaper than the mutual funds because the mutual fund FOF, fund of funds as it's called, will have the ETF as an underlying instrument, and therefore there will be 2 layers of cost in an ETF. So normally, if you look at returns in an ETF, it will be slightly higher than what you will make on the gold FOF. The disadvantage of an ETF is that it may not be easy for you to make investments if you don't have a demat account and a broking account, or if you're looking for things like investing gradually through methods like SIPs or STPs. And therefore, in those situations, you might find that mutual funds, even though they're a little bit marginally more expensive, may be a better instrument because they allow you to get in gradually. And especially in environments where prices have gone up very significantly, you might decide that if I need to participate in an asset like this, I will um, want to go through a mutual fund so I can put my money in gradually. The next question is from Mr. Manoj Rajendran. His question is, do you see any sharp downfall in gold and silver in 2026 year? Mr. Rajendran, unfortunately, I don't have that answer. I wish I did. I think, there is um, historical evidence, like I mentioned earlier, to show that one good year or one bad year in one of these assets is normally not a good indicator of what will happen in the following year. So even after a very good year on gold or silver, you could have another year which does very well, or you could have another year which doesn't do well. And therefore, my guidance on this aspect will continue to be that um, it is a good idea to keep your asset allocation as the driving force on making decisions on whether you should add more gold or silver into portfolios. So if I am an aggressive investor and I decide that, as an aggressive investor, it's a good idea to cap gold and silver exposure to 15%. If I've reached that level of 15% already and gone past it, then I would be selling, irrespective of whether prices will go up or down. If I haven't reached that level, I could continue to buy, being mindful that there has been a very sharp rally that has already happened, and I have to be ready for downsides that typically happen on gold and silver. I'll move to one more question that has come up on will the social issues increase by investing in gold and silver? So it's quite interesting that when you think about this answer from a lens of inclusiveness, you will find that gold and silver are actually assets where the exposure and ownership is much more broad-based as compared to most other asset classes. The number of people who own equities, the number of people who own real estate are much lesser than the number of people who own gold and silver in their households. And therefore, our belief is that um, the social realities of India are already showing that gold and silver are already sitting within portfolios. I think what happens is that when gold and silver prices go up, what could end up happening is more people end up taking gold loans and sort of use that money for consumption. And if their income does not keep up with that, and the prices of gold or silver or both are to fall, then they could end up into a bit of a debt challenge, or their gold and silver itself might end up getting sold. So you could end up seeing consumption pickups backed by a wealth effect getting created by rising prices of gold and silver, um, which if there's a sharp correction, could end up creating its own challenges. Um, Coming to one more question about my price, it's from Shubham Shakya about, in the current scenario, what is your view on gold prices in future? I wish to repeat that unfortunately I don't have a view on gold prices and silver prices in future. There are ways to value um, gold and silver. Different methods get used, but none of them, in our experience, have been very robust in terms of being able to predict where the prices of these assets are going to be. Because gold, for example, is also an asset of fear. And to what extent people will become fearful depends on the circumstances that present themselves out in the future. So I don't have a view on where gold prices will be. I only would caution that, whenever any asset class prices go up, whether it is equity or gold or real estate, you will see big, fat, round numbers being talked about across reports, across media, across a lot of channels, etc. I think be mindful that this is normal in a bull market. And therefore, just because some report has said that gold will go to $7,000 or $20,000 or $10,000 does not mean that it will go there. And therefore, your own asset allocation, your own 5, 10, 15% division, depending on your own risk tolerance, will probably be a better indicator on how to approach it. I'll move to the next question from Mr. R.S. Sundar about, is it worth investing in silver physical rather than ETFs? So I think the important thought to keep in mind is that silver as an asset is much bulkier than gold as an asset. And therefore, the storage of large amounts of silver is actually a very difficult method. And therefore, our preference would be that investors continue to look at silver ETFs as the preferred route, because it's very hard to actually manage physical silver, much harder than it is to manage physical gold. Coming to multi-asset funds, that was a question from Mr. Aswin Kalia. Multi-asset funds are a good alternative, again, for long-term investors. The way to think about this asset is to actually think about what is the investment horizon that you have, because typically multi-asset funds will have, by SEBI definition, at least a 10% exposure to three asset classes: equity, bonds, and gold. And therefore, depending on what the view of the manager may be, he might go over and above that 10% allocation. So you are exposed to the advantages of being in multiple asset classes, but also the risks of being in multiple asset classes. So what may have happened is, when you look at multi-asset funds, in the more recent past, they may show you very high returns because they may be having anywhere between 10 to 35% exposure to gold and silver. And as a result of that, the returns look very, very good. But if gold and silver corrects, or gold corrects, depending on how that multi-asset fund is structured, you could end up finding that that works against the fund. So I think it's a good option for investors, but they need to have a long enough investment horizon, be mindful about the returns being partly driven by the strong performance of gold over the last 12 months. Coming to a question from Mr. Akhtar Alam, which gold ETF is the best? I think there is a whole bunch of gold ETFs which are very good. I can tell you that the way to think about how to evaluate gold ETFs is important. So gold ETFs will typically be backed by physical gold. What you may want to look at is, what is the tracking error of the gold ETF versus the price of gold? So that is one parameter. So the lower the tracking error, the better the ETF. Second is, look at the expense ratio of the ETF. So the lower the expenses, the better the outcome typically for investors. And third is, look at the fact that there is enough liquidity in the ETF, so that if you want to sell or buy the ETF, there are enough buyers and sellers for you to be able to get benefits of that. So typically, if you look at ETFs on these three parameters, I think you will find for yourself which might be a good gold ETF to actually participate in. There are virtually all the fund houses actually have gold ETFs, and most of them are actually very good. There's one more question around how are gold and silver ratio calculated. So essentially, the gold and silver ratio is essentially the calculation of the price of gold against the price of silver, one in the denominator, one in the numerator. So that's how the ratio actually comes through. And what you keep looking at is the ratios over long periods of time. There was a question around, can we invest in multi-asset instead of ETF? That's a repeat, so I'll skip that because it came up earlier. There's a question about choosing gold and silver ETF. So I just spoke about how to choose a gold ETF. Silver ETF choices are very similar. You apply the same principles of tracking error, expense ratio, and liquidity. You need to keep in mind that silver ETFs do not have such long track records as gold ETFs have, and therefore the data that you get for them may not be as long term as you're able to get for gold ETFs. After the run of gold till 2025, gold can maximum possibility for consolidation the next 3 years around 1.2 to 1.8 lakhs. I'm sorry, Mr. Shubham Sakya, I don't have a view on that. I think we believe that those allocation decisions come from individual asset allocation choices. I think a trading view on gold is not something that we have a very strong view on. Coming to how would Fed rate cuts impact gold prices in India? Will it surge higher? Well, typically it could, because normally, lower interest rates are good for gold. But we need to remember that the RBI has already been cutting rates well in advance of the Fed. And therefore, just because the Fed cuts rates may not necessarily be the only factor driving gold prices. There are a bunch of different factors which come together, how the rupee does against the dollar, how uncertainty happens across, geopolitical events, etc. So I would say that the Fed rate cut could only be one of the factors that impact gold prices, and therefore should not be the only decision that one looks at when making choices about whether to add exposure to gold or not. There's one more question about, silver long-term value visibility being much higher from current value. Does it not warrant for a higher allocation to 20%? And for a high-risk investor, given the fact that global equity markets are in a high valuation. So again, like I mentioned, there is a 20 to 30% allocation to silver that investors who are aggressive could consider taking. But like I mentioned, the important element here is the ability to handle volatility. And I think even high-risk investors are, in our experience, are good with handling upside volatility, but are not the best at handling downside volatility, especially if the asset can remain flat to down for a very long period of time. And therefore, we continue to believe that, for very aggressive investors, maybe that 20 can become 30, but it's probably not a suggestion that we have that silver becomes a much higher number than that. There's a question about, does dollar versus INR price difference affect on gold price? Yes, it definitely does. That's what we saw, in the presentation as well, that how your returns show as a rupee investor in gold may be different from how they look at as a dollar investor. I think there's one more question around checking NAV and INAV because it's a problem. It's a good point. Thank you, Niladri Mondal, for bringing that up. I think, what can happen is sometimes ETF prices can go out of sync with the prices of the underlying asset, like we saw for silver in the period before Diwali, like I'd mentioned. So it's a good idea to evaluate and check what is the actual NAV versus what is the price at which you're able to buy on the stock exchange when you're buying an ETF, so that you're not buying at a very large premium to what the actual prices are. There's a question about views on gold and silver in 2026. Sorry, I think I answered that question already. Ideal period to invest in gold ETF fund of funds through SIP. Like we've seen historically, I think it's a good idea to think about um, these kind of assets also to be um, long-term assets. And I think, like I said at the start of the presentation, many investors are by default long-term assets in gold and silver. So I would say that if you're running an SIP, it's a good idea to think about 20 years when you think about SIP periods, because one of the realities just mathematically around a SIP is that your first installment goes in at the start of year 20, your last installment goes in at the end of year 20. So therefore, your effective period of making contributions is about 10 years. And like you can see from the data that we showed you, periods of outperformance and underperformance can be quite long in assets like gold. So therefore, if you are able to contribute for a 20-year period, I think that's a good idea. There's a question around indicators one should look for to stop investing or allocation to gold, irrespective of 15 or 20% of portfolio. I think that there are two things that we look for very closely. One is that um, are you able to see a lot of speculative demand typically getting created? And normally you will be able to see that through the frenzy around the conversations that you have over dinner with your friends, over how the media talks about returns, et cetera, et cetera. So speculative demand becomes pretty apparent. Like, for example, as a professional, we found that at certain points during the last 12 months, there was a very strong set of questions coming from all investors asking to increase gold and silver in portfolios. And very often we found that when that very strong set of requests came in, that coincided with a period just after that when prices actually came down. So it's actually a very good contra indicator in terms of what you should do. The second is whenever your recent returns are disproportionately higher than the long-term returns, I think you have to be very careful about the asset class, including gold and silver. We are sitting at a point where the recent returns on the asset are anywhere between 3 to 5 times the normal rates of return. And therefore, you would want to use that as a cautious signal rather than a signal where you want to go in and get more aggressive about it. Just trying to see what other questions that I have. Where can I find metal data from reliable sources globally and regionally? So I think there are some places like, for example, the Silver Institute, which gives silver data. There is the World Gold Council that publishes gold data. So some of those are credible sources for where you can get information around these type of demand supply pieces. The question for someone who is holding SGB and sitting at good returns at present, I think the important part here to keep in mind is, again, the allocations that you already have. What is the sort of allocations that you would want to put in to these assets? If you are, as a result of the prices having gone up and the allocations you've made more than 15% and you're an aggressive investor, you may want to think about cutting that risk because your portfolio may be overexposed to gold at this particular point. And that same principle applies whether you're holding it in the form of an SGP or whether you're holding it in the form of a ETF or a fund or even physical. There's a question about, should I invest in physical gold rather than ETFs? Unlike silver, where, it's a much larger asset. So again, physical gold also has its own limitations. You need to manage purity, you need to manage safety, security. You need to pay a GST when you buy those assets in a certain way, et cetera, et cetera. So I would say that if you do have a demat account and you are comfortable with a financial form of that asset because you know it's backed by physical gold, I would say then ETF is still a superior solution for you to look at. Um, and I'll just take one last question, which is what is the best platform to invest like in ETFs or shares or bonds or mutual funds? I would say that, I wouldn't be able to give any preference, but all I can say is that over a period of time, you have multiple platforms now available where you can participate fairly easily in most of these asset classes. I think the important part here is to avoid, um, you know, over trading in asset classes simply because it's very easy to actually invest or take out money from there. And I think what the platforms have effectively done by making it so simple is unfortunately also resulted in a lot of investors doing too many transactions on their portfolio because they're always worried about whether the price will go up or down. And therefore, they keep buying and selling all the time. And very often, that is very detrimental to the wealth creation journey and also creates a lot more taxes and a lot more cost for your portfolio. So I would just say pick a good platform and then largely stay invested in line with your allocations and asset allocations that are there. So I think I've answered all the questions that came up. Thank you for patiently listening to those answers.
Yes, I think you have all answered all of the questions because I was also seeing them. Yeah, just would like to extend our heartful thanks, sir. Your presentation, insights, and has truly made a lasting impact on our audience, sir. Thank you again, sir, for sharing your time and knowledge with us. Thank you, thank you, and
Thank you so
also
much.
thank you to participants as well for joining us today. Your presence truly made the session meaningful. Yeah, thank you all for joining us today. Thank you. Now I